Hi everyone, welcome back. All right, I want to thank you for your support. Thank you for sharing. Thank you for subscribing. Thank you for everything. If you haven't done so, if you haven't subscribed, please do well to subscribe, like, use the comment section. If there's anything you don't understand as we proceed, use the comment section, okay? All right, so we'll be looking at, under abnormal basis period, we'll be looking at the commencement of a business. Okay, commencement of a business. Okay, so now, how are the profits of a business that is just starting? How are the profits assessed? How are the profits assessed? Okay, now there's what we call the commencement rule. I'm going to share it on the screen and also post it on our Facebook page so that you have access to it. Okay, now when we say commencement, the abnormal business period under commencement of a business, we're trying to say how are the profits of a business that has been in operation maybe for the first 3 years. Okay, how are the profits apportioned so that it can be taxable? That's what we're trying to find out here. And these rules are similar to the ones in section 24 of personal income tax, which is also similar to those in section 29 subsection 3 of the company income tax. Okay, now there are 3 of these rules. There are 3 of them. Okay, number 1 says the profits made by the business will be assessed in the first year from date of commencement to 31st December of that year. Okay, let's say a business started operation 1st of August 2021. Okay, 1st of August 2021. Now this first rule is saying that the profits made by the business will be assessed in the first year. This is the first year now. In the first year now, it will be assessed from the date of commencement to 31st December of that same year. Now, if this company, ABC Limited, for instance, makes up accounts every 30th April every year, that is their accounting year, 30th April every year. 12 months is an accounting year, okay? If this company makes up account 30th April every year and they started business 1st of August 2021. Now, this first rule is saying that you calculate the first year will be 1st of August 2021 to 31st December 2021. That's what this rule is saying. Okay? Now, the second rule says the assessable income for the second year is the profit from date of commencement to the next 12 months. Date of commencement, 1st of August 2021. The next 12 months will be 31st July 2022. From 1st of August to 31st July 2022 is 1 year. That's 12 months. That is what the second law says. The second rule says the date of commencement to the next 12 months. Okay? Now, so okay, second year here will be 1st of August 2021, to 31st July 2022. This is 12 months. Okay? Now, the third rule says the assessable income for the third year will be the profit of the preceding year basis. The preceding year basis now is the next 12 months. Okay? The preceding year basis is the first 12 months. Okay? This one now is the normal basis. But in a situation where you don't have the normal basis, okay? In a situation where you don't have the normal basis, that's the preceding year basis on ground, you simply repeat the second year. Don't worry, we're going to see practical examples. You simply repeat what? The second year. Okay? Now, for first year, let's say this is 2021, for instance. Let's say this is 2022, for instance. Then the third year will be on preceding year basis. Preceding year basis is the year before the current year of assessment. That's what we mean by preceding year basis. The year before the current year of assessment. Okay? That's why I gave an illustration. I say if this is 2023, for instance, we are going to look at an example. I'm just giving instances for you to understand. If the third year is 2023, the preceding year basis is since the company makes up accounts 30th April every year, the preceding year basis will be 1st of May 2021 to 30th April 2022. This is 2023, right? The preceding year basis now will be 1st of May 2021, 1st of May 2021 to 30th of April 2022. This is the preceding year basis for 2023. So preceding year basis is the year before the actual year of current year of assessment. The year before the current year of assessment. Okay, this is just a rough illustration. So we're going to look at an example that will help us understand it properly. Okay, so now there are two questions here. Now, if I should add, now in the second and third year under commencement rule, in the second and third year, the taxpayer is given the rights of election. Now, what do we mean by right of election? Right of election simply means the taxpayer is given the liberty to elect that his second and third year profits should be based on actual basis, should be assessed based on actual basis. Actual basis. Okay? That is the right of election. The authorities grants the taxpayer the right of election. He has the taxpayer has the right of election under in the second year and third year of assessment. Now, this right of election we are talking about is that the taxpayer will say, okay, I want my second and third year profit or assessable profit to be based on actual basis, to be assessed based on actual basis. And actual basis is 1st January to 31st December of that year. For instance, if you are looking at 2022, okay, actual basis simply means 1st of January 2022 to 31st December 2022. That's what I mean by actual basis. And the taxpayer must give a notice to the relevant tax authority within 2 years after the second year, after the end of the second year of assessment. After the end of the second year of assessment, the taxpayer is supposed to give a notice to the authorities within 2 years. Okay? So that is basically all about the rules governing commencement of business. So we are going to look at some few examples. I have like 3 questions here. But how many of them? Let me see. Okay, I have 2 questions here. So we are going to use these 2 questions to understand this concept better. So now, let's look at the first illustration. Now, the first one says, Sheiks Promas Limited commenced trade on 1st of August 2000. 1st of August 2000. This is commencement. Okay? The accounting date is 31st March every year. 31st March every year. Accounting date. Okay? Now, and the operating result of the business as adjusted for tax purposes as follows. Period to 31st March 2021 is 1 million. Year ended 31st March 2022 is 1.2 million. Year ended 31st March 2023 is 200,000. Okay? Now, compute the assessable profit of the company for all the relevant years of assessment. Now, how do we solve this? Now, let's go. Sheiks Promas Limited. Okay? Are you ready? So we have, what is the name of the business? Sheiks Promas Limited. Okay? Computation of assessable, let me clean this off. Assessable profits. This is our heading, okay? This is our heading. All right, so now we'll go. Let's have a heading here, year of assessment, preceding basis period, and assessable profits. Okay? Assessable profit. Are we there? Okay. Now, the business commenced in 2000. So our year of assessment for the first year, according to our rule, the business commenced in 2000. Okay, now, according to our rule, remember, the first rule says the assessable profit will be from the day of commencement to 31st December of that same year. So the business commenced in August 2000, okay, to 31st December 2000 will give us, from August to 31st December, will give us how many months? August, September, October, November, December. That is 5 months, okay? 5 months. Now, the period to 31st March 2001 is how many months? That is August, September, October, November, December, January, February, March. That's 8 months, okay? August, September, October, November, December, January, February, March. 8 months. So we'll have, here we'll have, from this period to this period is 5 months, all over 8 months, times the period to 31st March 2001 is 1 million naira. Okay? All right. Okay, what I'll do, let me clean this off so that we can have a bigger space so that I can illustrate very well. Let me clean this off. Sheds Promas Limited. Okay, computation of assessable profits. Okay, so we have year of assessment, we have basis period, and we have assessable profits. Okay, so year of assessment, we are starting with 2000. That's the year the company started, the business started. Okay, 2000. Then the basis period, the first rule says from the date of commencement to 31st December of that year. We have date of commencement for this one is the business commenced 1st of August 2000, then to 31st December of that same year, 2000, will give us 5 months. So we're going to have 5 all over. Now, we don't have any entry for 2000, no value amount for 2000. We only have value for 2001, period to 31st March 2001. So now, from date of commencement to 31st March 2001 is 8 months. 8 months. So, but since we are interested in the date of commencement to 31st December of that same month, okay? From that period the business started to 31st December of that same month is 5 months. So we just take 5 months out of the 8 months. So 5 over 8 times 1 million naira. Okay? So we'll do the calculation now. Do you understand? Let's do the calculation now. 5 divided by 8, we'll have 0.625 times 1 million naira. So we have 625,000. 625,000. Okay? Do you understand? This is the first rule. According to the rule, date of commencement to 31st December of that same year. The business started in 2000. The start date of the business is 1st August 2000. So 1st August 2000 to 31st December of that same 2000 is 5 months. But we don't have any entry value for 2000. We only have periods to 31st March 2001. So we'll take the period of that 5 months out of the period, this 8 months, 2001. From the date of commencement to the period 31st March 2001 is 8 months. So take 5 out of the 8 from this value. So we have this. Now, 2001, the second rule says date of commencement, okay, to the next 12 months, okay? The next 12 months is July, 31st July 2001. Now, 31st July 2001. Now, from date of commencement to 31st December, we have, okay, year ended 31st March 2002. Okay, now from this period to this period is 12 months. Okay, now we have period 31st March 2001 will give us 31st March 2001 will give us 1 million. Do you understand it? Let me explain better. Now, the second rule says date of commencement to the next 12 months, right? That's the second rule. Now we are applying that second rule here. Date of commencement to the next 12 months is 31st March 2001, right? Now, from our question here, we have year ended, period to 31st March 2001. And this period here is 31st July 2001. So March is before July. Okay, so the period to 31st March 2001 is 1 million. So we are left with, from that March to this July now, how many months are we left with? We're left with, okay, March, April, May, June, July. You see, we're left with July, 4 months. So it's now be plus 4 over 12 times 1,200,000. I need you to take your time. It's a bit technical. Okay, it's a bit technical. Now, let me come again. First, the second rule says, first from date of commencement to the next 12 months, right? Now, this is the date of commencement. The next 12 months, 31st July 2001 is the next 12 months. Now, from date of commencement to 31st December 2000 is 31st March 2001 is giving us 1 million already from our question. Now, from 31st March 2001 to 31st July 2001 is giving us 4 months already. Don't forget, this July is in another accounting date of 2002. It's part of 2002 assessable period. Do you understand? So from 31st March to July here is 4 months. Then, this year ended 31st March 2002 is part, this 4 months is part of the 12. I don't know if you're getting it. I'm trying to make it simpler. This 2002 is the accounting date of, is the end of 2001. Because 2001, it started from 2001 and ended in 2002. Meanwhile, the 4 months we want to pick out is part of the 2002. That is why we are using this value of 2002, this 1.2 million, because these 4 months we are trying to get out of it is part of the 2002. Do you understand it? Okay, so we calculate now. 1,000 plus 4 over 12. 4 divided by 12. 4 divided by 12. Okay, times 1.2. Will give us 400,000. Okay, 400,000 plus 1 million naira. That is 1.4 million. Okay, 1.4 million. Okay. Now, the second year, which is 2002. Now, according to the rule, the third year of assessment should be based on preceding year basis. And preceding year basis is the 12 months before the current year of assessment. This is our current year of assessment. 2002 is our current year of assessment. This 2002 is our current year of assessment. So preceding year basis is the year, the accounting period before this current year of assessment. And preceding year basis is for 2002 now. Since the company makes up accounts 31st March every year. So the accounting period, the preceding year basis period for 2002 will be first, if the company makes up account 31st March every year, that means it starts in April. Do you get it? The accounting year starts April. Now, listen to me. If my business makes up accounts 31st December every year, that is to say, we start 1st January every year. If we make up accounts 30th September every year, that is to say, we start accounting October, 1st October every year. If we make up accounts 30th April every year, that is to say, we commence accounts May, 1st May every year. So if this company makes up account 31st March every year, that is to say, they start account or they commence account April every year. So our preceding year basis will be 1st of April 2000 to 31st March 2001. This is the period, preceding year basis period before this. For 2002 year of assessment, this is the preceding year basis period. Preceding year basis. This is the period. So we'll now check our information. Do we have this information on our question? This is 1st of April 2000. Meanwhile, the company started 1st of August 2000. So April is before August. So we don't have this information. So according to the rule, if you don't have information available for the 3rd year, simply repeat what? The information for the 2nd year. So you just come here, put 1,400,000. That's it. 1st of April is not here. The business commenced 1st of August, and this is 1st of April. So there's no information available from 1st of April. So that automatically cancels the preceding year basis rule for 3rd year. So now we just repeat what we have on the 2nd year. Now come for the 4th year, 2003. Okay? Still 2003 is based on preceding year basis. So you come 1st of April 2001 to 31st March 2002. Preceding year basis not available. Not available. Okay? Okay, let me make it this way so that you understand it. Preceding year basis not available. So you simply repeat 1 August 2000 to 31st/7/2001. Okay? 1,400,000. Just repeat it. Then 2003, we have 1st of April 2001 to 31st March 2002, preceding year basis as well. Okay, so let's check if we have information available for this. Year ended 31st March 2002. Okay, we have it, 1.2 million. Okay, so 2004. Preceding year basis will be 1st of April 2002 to 31st March 2003. Preceding year basis as well. Do we have any information ended 31st March 2003? Yes, we have 200,000. All right, so this is the assessable profit of Shakes Thomas Limited. This is how you calculate the assessable profit. Okay, please, I need you to take a deep breath, okay? Do not rush. Go to the comment section, ask me a question where you don't understand, and we'll treat it together. So let's move over to the second question. Are you ready?